Hello and welcome to another episode of the Investor Financing Podcast. I'm your host, Beau, and welcome to the show. We got Agostino Pintus. He is a multifamily investor, syndicator, entrepreneur with more than 15 years of experience. I first started to watch and listen to your podcast actually years ago. I think probably when you were starting it, Bulletproof Cashflow. It's a great show. You do a great job there. So welcome to the show and thanks for joining us today and looking to dive in. It was nice talking with you.
Yes. Hey, man, thanks for having me on. I greatly appreciate it. But yeah, absolutely right. It's one of the things about doing these shows is that you get to mix it up a little bit with these great people that they're pretty much located all around the world. That's great. Yeah, super.
So you've been in real estate for a long time. You're not somebody who just got started. Like many people you're seeing on the internet right now, they're like, they bought their first deal and it's been like 2020. You've been around for over 15 years in real estate investing. What led you into real estate investing?
It was fear, actually. The mindset back then was very much broken. I was working in corporate. I was a C-level executive working in corporate America. And it was really, I just went on a whim. I actually became an accidental landlord. I didn't realize what I was doing when I did it, but ended up making a move from Michigan to Virginia to take this job. And I found just someone to rent the place that we're living in Michigan. So I'm like, okay, here, rent it out, whatever. I wasn't even thinking about being a landlord as much as I was more concerned about hurry up and get someone to rent this place out, because I was always in fear. Is it, like I said, a very different mindset back then, very focused on the career. And not saying there's anything wrong with it. It's perfectly fine. It's just that it's very different than what I do today. But someone mentioned at the office I was working at that, hey, you should do real estate. Of course, this was before 2008. And so started doing like single family homes, and primarily is what I was doing, single family, small multifamily, things like that. But I developed these principles back then on how to buy these certain properties. And back then I had no idea what hard money was. I had no idea what these types of special financing vehicles that are very commonplace today. I just didn't know. They existed. Many things existed. I was just, again, I was just a C-level guy working at a company focused on my job. I just went to the bank and got a loan. That's how you do it. You can, back then, I don't know if you can I'm sure you can do the same thing now. You can do up to 10 of these houses under your own name or something like that. That's how I was doing it. So, but eventually, the way that I did it was if I could not cash flow this deal with enough cash to cover the note, I wouldn't buy the house. And I saw how the pricing, at least in Virginia anyway, was climbing so fast. Like we're talking within days, how much a property would jump up by thousands of dollars in a single day. That basically got priced out of the market. So I stopped buying for for probably about a year leading up to the 2008 crash. And it was sticking to those principles. I still apply those principles even today. A very, very conservative type of mindset when it comes to acquiring assets. Although today we acquire much bigger assets in single family homes. But yeah, it's been quite the journey, I'll tell you that.
So most of your holdings now are in the Ohio market, specific to Cleveland is where the majority, and that's your focus right now.
Yeah.
So you were buying, you then got into buying bigger multifamily properties. I believe you sold off the majority of your single families back then to focus on acquiring these larger apartment buildings. So can you kind of talk to like today, like what your business looks like? I know you're kind of like vertically integrated with a couple different businesses, and can you explain kind of your business model?
Yeah, absolutely. So what we do is that we actually have 3 lines of business that we syndicate, right? We have our stabilized value add multifamily type of deals, mostly B and C class stuff. We'll go in, we look for the opportunity to improve the property, bang up the rents, make it a great place for the residents to live. They love being there, and typically we have try to make these people happy, get them to stay for the long term, right? It's a typical scenario that most people do. We do a GP-LP split in favor of the LP. longer term hold, do the refi, cash out the LP. They still stay in the deal, of course. They still have equity in the deal, and we just basically cash flow it until we sell it, and that's it. Away we go. We also have development, right, which is a fairly new thing that we did, where what we're doing in that case is we're developing multifamily assets. Currently, I'm actually in one of our assets right now. This is the Rockefeller building in downtown Cleveland. It's a historical asset that John D. Rockefeller built back over 100 years ago. What we're going to do with this asset is take it and convert it to multifamily. So 430 some units here. It'll be a $135 million project when it's done, just this one. But we also do ground up developments as well throughout Cleveland. So there's definitely a need for housing here in the city. So a lot of jobs moving in, and it makes sense to do it. So we're doing those types of developments as well. And the third line of business is a single tenant net lease. Okay, the single tenant net lease type of asset allows us to give a return to our investors, a monthly return, right? That's very, very stable. And all these single tenants that we're going after are backed but with a corporate guarantee, right? And the corporate guarantee means that, like Dollar General, for instance, we go and buy Dollar General, right? It may come as a surprise to some people in your audience, but Dollar General does not own the store. They lease that location from investors like people listening right now. And they guarantee that lease, right? So even if Dollar General goes out of business tomorrow, the lease is senior to even the shareholders, right? So it makes for a very great and stable type of asset, right? And we designed these three different scenarios for our investor community so they can enjoy a nice steady return, keep their money with us, and so we can put it to work for them. And each one has their own risk-adjusted return, right? Their own little thing that as to how they work, right? The development, as you can imagine, it takes a little bit longer to get your money out because there's a build-up time, And on that lease, it's a shorter amount of time, but it's a risk-adjusted return. It's not going to have as much juice as, like, say, a multifamily or development, but it's a monthly return because we know how this thing's going to cash flow with a high degree of certainty.
And do you ever have plans to create like a fund where you can diversify? So somebody could say, "Hey, I like what you're doing, but I just don't want to go in this deal. I want to go in these three deals," and then that fund could take a share. That would be kind of cool, though. It's kind of like you're getting the best of both worlds, and you're also diversifying. I don't know if you ever thought about that.
Not you mean maybe between the properties, right?
Yeah.
No, I never thought about that.
It's probably too much paperwork.
Yeah, that would be very, very tricky because I think that the deals that we're doing right now are fairly homogenous in their own vertical, Like in the net lease, for instance, our fund calls for us to buy 8 to 10, maybe 12 of these locations across the country, right? And they have to be good, solid deals and good in the locations that we prefer. And all those deals, even though there might be Dollar General, Dollar Tree, maybe Advanced Auto Parts or whatever, they're all fairly similar, right? They'll have corporate guarantees. They all have maybe it's a double net or a triple net, but they're still they still have certain criteria that we underwrite to, right? So it's very easy to swap them out for alternate assets, and the investors shouldn't really know the difference. But if you're trying to do between, say, a development deal and a multifamily deal and a net lease deal across, I think it might be
that's
tough
true
to do that. Yeah.
So are you doing individual syndications on each of those, or is this this net lease business, is that a one fund?
Yeah, right now it's one fund. So
Okay.
It's one fund that we have cooking. And so people invest in that fund and we go and buy the asset, right? And all we do all day long is try to find assets that really fit our model, right? And that's the thing. I mean, doing all this stuff right now is very, very, it's not exactly easy, and it's not for the faint of heart. It's a lot of work. It's a lot of work trying to find good deals right now. Even on the multifamily and the stabilized multifamily side, we have nothing in the pipeline currently here in Cleveland anyway. I mean, we're looking at deals. We turn down a lot of deals just because they just don't make any sense for us. On development side, we have, I think, almost $100 million worth of deals right now that we're signed up for already. So it's like the development side of the business and the net lease side of the business are both like on the upswing, and the stabilized assets, not so much. It's only because we're very, very careful about what we're getting into, right? We're very responsible with our income, or with our money rather, and the money of our investors. So we're not under the same pressures to buy like many of these other syndicators are, because we don't collect acquisition fees on any of this stuff, right? That's the key difference. We don't charge an acquisition fee. So like we don't have the same pressures of hurry up and buy something because I need a paycheck. For me, it's like we buy it, we don't buy it, I don't care. I'd rather not buy a bad deal. That's ultimately what our motivation is. We don't want to get into a bad deal. We don't want to overpay for a deal either. So we just want to do it. Very, very careful about that.
What's your kind of overall viewpoint? Like right now, I'm like torn. It's like obviously there's a shortage of inventory everywhere. It seems like pretty much everywhere. We have huge inflation. We have, there's a war going on. We still have COVID, which is, starting to slow down a lot, which is good. But we had the, presidential change. Like the last 4 years have been kind of like huge drama, and prices during COVID had like you would think in the beginning, everybody was scared. I remember in these mastermind groups I was in, everybody was having these like meetings and like what to do. And all of a sudden it was like, we're in a new boom. And what's your kind of like view of like what's going on right now, and like what investors should be looking for potentially? I mean, obviously money sitting on the sidelines is losing money, right, because of inflation. So you got to invest. And what's your kind of view of like what's going on with people overpaying for deals, with rates going up? How do we stay insulated?
Yeah, we're talking about this in the green room a little bit, right? It's experience. Experience could be a very good teacher. And I remember back in those days, even though I wasn't focused on real estate as much as I am now because I was doing the corporate thing, one thing I do remember was this, I think it was Greenspan, who was the chairman at the time, I believe, or thereabouts, this irrational exuberance, right? Although back in 2008, there's a different set of conditions that caused that crash versus what's going on today, I still believe that real estate is the safest place to put your money. You're taking this asset that's going to zero faster than at any point in history, and you're able to trade it in for a hard asset that makes money. I mean, that's a no-brainer, right? The key, though, is getting into a decent asset with that makes sense, right? That makes sense. And that's why my team and I are very, very, very careful about the deals that we do, right? I can't say everything's risk-free. There's no such thing, right? But the deals that we're doing, like this Rockefeller building, for instance, right? Obviously you can't see if you're looking at me right now, but literally right over this wall over here, Sherwin-Williams is building the world headquarters right over the street. Like literally right, there's a street, and then they're building world headquarters. It's going to be 6,000 new jobs right over there, not including all the support jobs it's going to bring to the local area, right, to support this business, right? They're building a skyscraper. So do you think this is a low risk deal? I would say no, right? There's people who need a place to live. All of our development deals are ground up deals, right? Those are being built in primarily around Cleveland Clinic, right? Cleveland Clinic's going to be hiring 20,000 new people over the next 10 years. It's healthcare. As long as there's people around, which I'm sure there will be, it's fairly low risk. Those people all need a place to live, right? Those doctors, the nurses, the people supporting the hospital, they need places to live. That's what we're building. We're building stuff near there, right? So jobs are a really big motivator. And when it comes to the net lease business, again, we're looking closely at those leases. We're looking for how many vehicles per day are going into a certain area, and how hot is the area? Is it on the upswing in terms of population and income? If all those things are still there, if those metrics are there, we feel comfortable with it, we go ahead and make a move for that property. So we try to be very, very, very careful. And if the numbers don't make sense, we don't do the deal. It's as simple as that, Very, very different than some of these other guys that are getting into these appreciation markets. Let's say like Florida. I love Florida, but I can't see spending $350,000 a door when it's $1,200 a month. I don't get it. It's just that it's almost like you're hoping that that asset's going to appreciate enough that you can then sell it off to someone else. It's all at a certain point in time. So you just have to hope that 12 months or 24 months from now, someone's willing to pay $425,000 for that deal. You paid $350,000 for it.
I mean, it's kind of it isn't kind of, it is a speculation play when you really think about it. We've had tremendous rent growth. At some point that's going to run out. So
that's why I call it bulletproof cash flow, not bulletproof appreciation. Bulletproof appreciation would be ridiculous. Cash flow is not ridiculous.
Yeah. I mean, I was amazed when I researched Cleveland about like there's like a lot of big companies there. I didn't even know. I'm like, that's a market. Like for me, I'm buying smaller properties, but that's a good market. I mean, there's just so much going on there. It really is like a hub for the Midwest, isn't it?
Yeah, it is. But the thing is too, Beau, is that my team and I are focused on one market only right now. I mean, we are planning to make a move into another market. When we do, we're going to go deep on that market as well. But that's one of the key features of how we do things, is that because we're so hyper focused on one area, on one market, that we know who the brokers are, we know who the lenders are, we know what's going on here, we know who the players are. So it isn't like it's a guessing game, right? It isn't like I'm buying 100 units in Tennessee and then 100 units in Las Vegas and 100 units in Dallas and 200 units in Louisiana. I'm not doing any of that stuff, right? And if someone out there is doing it, kudos to you. I'm not slamming or anything else like that. It's, I'm not mad at you or anything. I'm just saying, like, our approach, my approach, is to reduce the risk as much as possible and still hit the same return targets that other people are hitting or more. That's my game that I'm doing here.
I like that, because a lot of the people I interview in the multifamily space, they're buying in emerging markets, and they're not where you're there. Your boots on the ground. You can go kick it. You can drive by it. You can do your. Now, do you guys outsource property management, or are you guys vertically integrated with the property management?
Yeah, so my partner actually is part owner of the property management group, right? So I guess you can say we're vertically integrated, right? But we also try to vertically integrate all the other components that go along with the business as well. So we're in the process right now of acquiring an insurance company. Right, so we're trying to put that together right now. We're looking at also acquiring a landscaping company, acquiring all the supporting businesses to support the portfolio. Right? Why do we do that? Well, because if I could control the overall experience of that resident is going through, there's a better chance they're going to stick around. And if they stick around, what does that mean? They're happy, and also means they're not leaving as often, and it reduces your overall turns, your unit turns, right? Which is what you're going after. So I mean, it's a win-win-win for everyone.
Plus, you can manage costs a lot better. Let's face it. You get, it's when you have third party anything, you're anytime a service call is taken, right? You're just paying. You're paying a lot, and that's eating a lot of the cash flow, especially on these smaller properties. The bigger properties too, but smaller properties get eaten alive because there's no way around that. But
yeah. I mean, we're right now we're in the process of scaling up into larger properties. I mean, on our development side of things, the unit count are a little bit on the smaller side currently, but the ones we have coming up are going to be much larger. But development's a little different, But when it comes to stabilized assets, we're sticking to 100 units plus. The last two deals were 300 units each that we did. So a little bit on the larger side there.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, if you'd like to book a call with me and discuss SBA financing, whether it's a 7A or 504, or you just don't know where to start, maybe it's a startup business, you're buying an existing business, you're buying a franchise, you're building a new office building, you want to expand your existing business. We have multiple solutions. I can walk you through the 7A and the 504 and the SBA loan process. And if you have any other questions on any other types of financing, I'm happy to book a call with you. The link's below. Look forward to seeing you soon. So the building you're in right now, you're doing a huge, what we say in the industry, adaptive reuse, right? You're taking an office building and you're converting it to a higher, better use, which is multifamily. And that's going to be 430
multifamily, something like that. Yeah,
430. And so, are you guys in the planning stage with that right now? And it's
right now we're working on getting the construction financing nailed down. Right, so we're going through that process right now. We already have the term sheet and all that fun stuff, so that's already done. So we're working on just like getting that rolling, right? So looking forward to getting things spinning over here. I mean, it's been a long road, to tell you that. Very long road.
That's a monster project. That is definitely
It's huge. It's huge. Yeah.
And they're not going to be condo, just straight multifamily.
Yeah, just straight up multifamily. So the very lowest level is going to be like restaurants, maybe a bar, maybe like a speakeasy. We're thinking perhaps, something along those lines. But first floor and basement. Then you're going to have 2 floors of office. Then the rest of it's going to be multifamily, right? There's 17 stories here, right? So it's a good sized building, right? I think the floor plates are, 35,000 per floor, thereabouts, on average. So, it's good size. So it's going to be it's going to be one big community, that's for sure.
Yeah, that's amazing. That's a legacy project right there.
It is. It is.
That must be exciting. Did you guys start working on this years ago? It's a long time in the making.
Yeah, it is. It is. We actually closed on this thing. Well, we got it under contract just before COVID, or before COVID was a thing. We didn't even know COVID was not even a thing back then. When we got it under contract, and then once COVID hit, all the lenders stopped lending, and that was a whole scenario right there. I mean, that's a whole show, by the way. That whole thing is a show because it was quite a learning experience. I'll tell you that because technically this was our first development deal. I never did a development deal up until that point. And it was quite a challenge, but we got it done in terms of the acquisition. So now are we finally getting this the construction side thing, the construction rolling here. So very, very excited about that.
Yeah, now that's exciting, and it's not just a construction project. It's like a monster project.
It's huge, yeah.
But it's amazing though because it's infill, and you have the building next door, which is going to have thousands of employees. So it sounds like it's going to be a very successful deal and exciting. It's exciting, and I like the fact that you're right there. You're boots on the ground. I mean, you're going to be there meeting people. So and that's the other thing about being local is you meet the local politicians, you get to know people in the town, the planning commission, and that's how you kind of grow internally. So I think it makes a lot of sense. If I was in a market that had potential like your market, I would probably do the same thing. Like in Las Vegas, just things don't cash flow like they do other places.
Yeah, I think part of it is that to do deals here, it's there are certain advantages, like there's opportunity zone, there's tax credits, there's different things you can apply to help a deal work very, very well, right? So when you compare certain markets for development, for instance, it's very hard to beat. And that's the problem. Sure, I can build stuff in Arizona or your neck of the woods, but I won't get the same tax benefits, for instance. I'm not going to get a tax abatement for 15 years in Nevada or Las Vegas. Why would they give you there's no reason to give you a tax abatement. Why would they do that? I mean, I don't think there would be anyway. I'm not, I would imagine there wouldn't be. So, but it's kind of like that, so you just have to, but you have to know the rules. You gotta know how to play the game. To your point, you gotta know who to talk to. And that's the tricky part. And, this isn't something that I just woke up one day and decided to do. I mean, many of the things that we work on, they're years in the making. Like the net lease funds that we just launched recently. I've been thinking about doing a net lease fund for about 3 years. I decided 3 years ago that I was going to do it, right? And only now were we able to dedicate the energy to get the team together and make the investment to make it a real thing, because we had to make sure that the first line of business was running properly before we can dedicate our resources to the second, right? So yeah, I mean, it's a matter of understanding what's going on in that market, understanding your own resources as well.
And so on your podcast, who have you interviewed that you like was one of your favorites that you can say that was like an episode that if I were to go listen to one of your episodes that you enjoyed it? It could be a personal reason why you enjoyed it. Could be on like personal development, could be in real estate. What episode do you think really you enjoyed?
God, I've done over 300 interviews, right? Mm-hmm. Did a lot of interviews. I think it's because I remember this a little bit easier because it was fairly recent. But there's one with Mary Buffett, and if the name sounds familiar, this is Warren Buffett's ex-sister-in-law, right? So she actually wrote several books on Warren Buffett, right? So it's kind of like it's very interesting to get a feel for how Warren Buffett thinks and how he does things, in terms of investing in the right types of deals. We had a very good discussion. We were actually supposed to meet up in Sarasota too, so I still have to take her up on that at some point here soon. But yeah, we did develop a friendship as well, which is nice.
I like how Warren Buffett still goes to McDonald's and drinks cherry Coke every day.
Yeah.
He's classic, that guy, and he drives like his old Cadillac.
Yeah,
and he's like one of the richest men in the world. I don't know. You got to love the guy. I mean, just to grow that huge, it's unbelievable.
And he was 98 years old or something like that. Still, it's great. Yeah.
So what do you do to keep yourself? I know you're really into personal development. What does a day look like for you? Do you do any morning rituals, or you just what does your average day look like?
For the first part of the day when I'm having breakfast, it really is. Lately, anyway, it changes up. It's been Bob Proctor, right? I spend my mornings with Bob Proctor, and really understanding how to overcome personal limitations, things like that. And it's kind of funny, even though you hear it a bunch of times, it's nice to have the reminder. It's nice to have the reminder, right? And I hear it every day, but we forget. And just by living life, we often forget. And the morning it's my time to really get recentered with what the purpose is. I spend time also writing up my goals, trying to plan out my day, and try to figure out how I'm going to achieve those goals that I wrote out. It's phone will ring, I'll get emails, whatever, text messages. I ignore all that until that stuff is done, because I'm the priority. I have to make myself a priority above all else, right? Because if I can't be there for my family, if I can't be there for the people that depend on me, then then it's gonna be a very hard life, right? Yeah, man. I mean, that's one thing that I do every day, and it's important that it goes down that way. It's I think having setting some time aside for yourself and defining what your personality, or not personality, but your personal goals are going to be is very, very key.
How long have you been doing that?
So it changes, so before it was before Bob Proctor, which I've been listening to for about a year now. It was I was actually listening to a lot of Grant Cardone, but on his motivational stuff. And then before that, it was Ty Lopez, and it just depends on who it is. I'll switch it up after, usually it's 6 to 12 months. I'll switch it up a little bit, right? I don't listen to the same people, right? Sometimes I'll listen to even two of these different guys, and to try to acquire a bit of wisdom to help me through the day, right? But the key is again, spending time for yourself and developing Do some personal development of your own, do some introspection. It's very important that you do that, in my opinion. Anyway.
Yeah, no, I mean, people that write their goals down are like 99% more. It's going to happen for them 99% more times than the person that's not writing their goals down. So it's interesting that you're doing that. I like how you're doing it every day. You're kind of reflecting, almost journaling, right, in the morning, and then planning out your day. Like, okay, these are my 2 or 3 top things that I'm going to accomplish, and then you dive into your day after that's all accomplished.
But the thing is, though, as I mentioned this a second ago, like this whole net lease business. I thought about the net lease business. I was thinking about it 3 years ago. I decided I'm doing net lease, and I started writing it down. It's on my vision board. It's kind of like it isn't just I woke up one day and said I'm going to do this. It's kind of like it's always been there all along, right? And so the act of goal setting is so important, right? And without it, if people don't take the time to document it and their goals and really do that introspection, they just go from day to day to day, just getting up, going to work, to a job usually they hate, like I did, spending 10 hours working for some jerk that you don't like anyway. They don't want to be there either. And then what do? You come home, have dinner, sit in front of the TV, go to sleep and repeat for 5 days and pray for Fridays and dread Mondays. That's no way to live. It's no way to live. You have to live on purpose. You got to live on purpose. It's very important.
That's really good. Well, we have taken your time for this allotment. I could sit here and talk to you and ask you many more questions, but you provide a lot of value. Where can anybody out there that wants to learn more, maybe they're want to see what opportunities that you have in store for them, where's the best place to find out more information about you and your business? Yeah,
sure. Bulletproofcashflow.com is the best place. We have all kinds of great stuff on there. We're going to start doing events here again very soon. We're doing a weekly event, and we cover all kinds of different things on just how to make money, how to build wealth, things like that, and totally free, and really just to help folks out. So if you go to Bulletproof Cashflow, we have a Facebook page, Facebook group. We're on Instagram, we're on LinkedIn. We're pretty much on every social platform. So yeah, just connect. Go ahead, give me a shout.
All right. Well, thank you so much. This was a very enjoyable conversation, and I look forward to staying connected with you so I can follow you as you get this adaptive reuse project off the ground and convert it into over 400 some units, and that's very exciting. So it's awesome hearing about the journey and learn a little bit more about the Cleveland market. So appreciate you.
Yeah, man. Thanks so much.